Hi, this is Jessica Dunn, and today we're going to talk about profitability ratios. So what are profitability ratios? These are metrics that allow us to assess a business's ability to generate earnings or to make a profit, um, to generate earnings relative to their revenue or to their operating cost or to their shareholders' equity or to their assets. And to do this, we're going to use data from a specific point in time. So they basically assess the ability to earn profits either from sales or operations or relative to assets or to equity. They're going to help us to measure efficiency. So how much money are they keeping at the end of the day relative to the amount of money invested in the company? Generally, a higher ratio is more preferable, but it really makes the most sense whenever you look at the profitability ratios relative to a specific company over time or across industry. So if you look at to see how your profitability ratios for your specific company have changed over time, that gives you some insight, as well as if you compare the profitability ratios from your selected company to a group of similar type companies or the industry average. That helps you to draw some meaning from that. So generally, the higher the profitability ratio, the better. So if your profitability ratio is trending upward over time, then you're becoming more profitable. Or if it's higher relative to your competitors, then your company is performing better than their company. Um, it really helps if you only compare your company versus those within the industry because industry profitability is going to be substantially different across industries rather than within your specific industry. When we start looking at financial ratios, first up is the gross profit margin. Gross profit margin is the most broad measure of profitability. Here we're only looking at our sales minus our cost of goods sold, and we divide that by sales. Um, so this is, again, the broadest measure of profitability. It's not factoring in any of the operating expenses or financing expenses. So it's really a good measure to look at how we are charging relative to our base expenses. Are we charging enough to cover our inputs? Is our raw goods materials being adequately upcharged? Um, so to calculate that for our company, sales is 3,074,000 and cost of goods sold is 2,088,000. So that 3,074,000 minus 2,088,000, and we divide by sales of 3,074,000. And that gives us a gross profit margin of 32.1%. So when we're only considering the cost of our goods sold, we are keeping 32.1 cents of every dollar in sales. Is that good or bad? We need to look at that in comparison to our industry as well as our historical averages. Operating profit margin. This is operating profits divided by sales. This is a more restrictive measure of profitability, and it's a better measure to use when analyzing a manager's performance because they have within their control um, the operating expenses. They may not have in control, per se, the cost of goods sold. Um, that is going to fluctuate, but they can control operating expenses. This is sort of a middle ground profitability measure. The more restrictive measure is net profit margin that we'll cover next, and that also includes expenses related to our financing choices, which is not within the manager's control. So operating profit margin is a better measure than net profit margin and better than gross profit whenever you're looking at the performance of a manager. And so it's operating profits divided by sales. Our operating profits were 418,000 and we divide that by sales of $3,074,000 to get us 13.6%. So once we account for our operating expenses, we are keeping 13.6 cents of every dollar in sales. Our net profit margin, this is the most restrictive measure, and here we're looking at our earnings available to common shareholders divided by sales. Remember that earnings available to common shareholders is the last line on the income statement, so all expenses have been made, those related to taxes and those related to our capital structure. And those decisions are not necessarily within the manager's control. So this is, at the end of the day, how much money did we get to keep from sales? How much money is going back into the company or being paid out to shareholders? That can be divvied up in different ways. But earnings available for common shareholders was $221,000. We divide that by sales of $3,074,000, and we get 7.2%. So we were keeping 7.2 cents of every dollar in sales from in revenue. So at the end of the day, is that good or bad? It depends. What have we done in the past? What is our competitors doing? Of course, it's positive, so that's good to start with, because you could have a negative net profit margin. You could have lost money at the end of the day. We can also calculate our earnings per share, which is the earnings available to our common shareholders divided by shares of stock outstanding. This is basically just taking the money left over and determining how much is attributed to each individual stock. So if you owned one share of stock, then your earnings would be equal to 1 earnings per share. So whatever this number is times 1. If you had 10, it'd be multiplied by 10. That would be the earnings that are attributable to the shares of stock that you own. So earnings per share of stock. Earnings available to common shareholders was $221,000, last line on the income statement. And we divide that by shares of common stock outstanding. Now this is not necessarily something that's easy to find. Of course, it's always available on proxy statements or 10Ks. But within the financial statement, sometimes it can be difficult. One way that you can always find it is to take the dollar amount beside the par value of stock and divide it by the par value. That gets you shares outstanding as well. But it's usually listed as a footnote somewhere, as it is in our table. So it's 76,262. And that gets us $2.90 per share of stock. We have earnings attributable to each share of stock of earnings of $2.90. So with earnings per share, higher is better, of course, but you do need to take into consideration the shares of stock outstanding, and with that, the potential for share dilution. So if new shares were issued, that would obviously result in a larger denominator, which would result in a lower earnings per share. Earnings per shares, that's also greatly affected by the company's ability to meet analyst expectations. So if a company doesn't meet analyst expectations and we see stock prices decline, so it's a widely watched ratio, and it does have some drawbacks just because of share dilution and such. Return on assets. This is earnings available for common stockholders divided by total assets. Basically, this number allows us to see how efficiently a company is using their assets to generate a profit. We calculate it as earnings available for common shareholders divided by total assets. So a higher ROA means that a company is more efficient and more productive. They're better able at managing their balance sheet to generate profit. And lower ROA means that there's a lot of room for improvement. So we can calculate this using our our company. We know earnings available for common shareholders is $221,000, and we know total assets is $3,597,000. So that's 6.1%. In isolation, this doesn't really mean a lot. It is useful when compared across the company itself and across industry. It allows us to determine if the company is using its assets efficiently and how efficiently they're using it. Basically, how much profit are they earning from the assets under their control. Next up, we have return on equity. Return on equity is looking at how efficiently the company is using investor funds to generate a return. So the higher the return on equity, the better a company is at converting its equity financing into profits. So we can calculate that for our company. We know earnings available to common shareholders is $221,000, but we have this new line item called common stock equity. To calculate common stock equity, we take total equity, that 1,954,000 on your income statement, balance sheet, on your financial statements, and we subtract from that the preferred stock of 200,000. So that gets us $1,754,000. So we divide our 221 by 1,754,000, and that gets us 12.6%. Again, that needs to be judged in relation to the industry. Basic earning power. This allows us to compare companies with different tax structures and different capital structures. So it allows us to make comparisons without getting bogged down by capital structure decisions and tax effects. So we can calculate basic earning power. So it's calculated as earnings before interest and tax. Calculated as earnings before interest and tax, which is $418,000. We divide that by total assets of $3,597,000, and that gets us 11.6%. This needs to be judged in relation to the industry as well as historical averages.